Welcome to enrichminds.com and our session on stocks. This is our first session on a specific asset class. In the next few sessions, we shall study one asset class at a time. In this session, we shall explore what are stocks, what are the kinds of stocks, and why one should consider investing some portion of one's money in stocks. By buying even one stock in a certain company, you become a part owner of that company as long as you own that stock. Shares, stock, and equity all mean the same thing. By buying even one stock in a certain company, you become a part owner of that company as long as you own that stock. For example, for the quarter ending March 31st, 2022, Apple had 16.2 billion shares outstanding. Say you bought one share of Apple. By doing so, as long as you hold onto that one share of Apple, you would be 1 over 16.2 billionth owner of Apple. Let's see what that means. People invest in stocks because they hope to earn a better return on their money than they could with a safer alternative, such as a savings account. Investors can earn returns on stocks in two main ways. First, price gains. If you buy a stock when the share price is $100, it rises to $150, and then you sell it, you have made a $50 profit or a 50% profit. And second, dividends. Some companies pay out a portion of profits to their shareholders in the form of cash dividends. If you own a stock with a price of $100 and it pays out $2 4 times a year, you're earning about 8% per year. There are thousands upon thousands of stocks you can choose from, and they're generally sorted into a handful of categories, including common versus preferred. Common stocks, these are what people really mean when they talk about stocks. And preferred stocks are technically also stocks, but really a different beast entirely. Preferred stocks generally pay high fixed dividend rates and do not swing in value the way common stocks do. They are stocks that act almost like bonds. Domestic versus international. Domestic stocks are issued by companies based in the United States or an investor's home country, even though many United States companies do business all around the globe. And international stocks, which are issued by companies headquartered elsewhere. Growth versus value. Growth stocks are issued by companies with rapidly growing sales and/or profits. Any investor who's hoping to find the next Facebook is probably focusing on growth stocks. Value stocks are stocks that are selling cheaply compared with the underlying company's profits. Large cap versus small cap. Large cap stocks are issued by companies with a market capitalization of $10 billion or more. Mid-cap stocks are shares in companies with a market capitalization of between $2 to $10 billion. Small cap stocks are issued by companies with a market capitalization of $2 billion or less. There are also micro, mid, and mega capitalization stocks, but generally the three categories of large, mid, and small are sufficient. Further, we can also classify stock by sector or industry. There are various sector and industry classifications based on what a company does, including energy, technology, healthcare, and utilities. You might choose all your stocks from a single category, but experts usually recommend choosing some from each bucket to diversify your investments and balance your risk. By objective of investing, stocks can be categorized into three main types. First, income stocks. Income stocks are equities that provide regular income by distributing a company's profits or excess cash through dividends that are higher than the market average. Typically, these stocks, think utilities, have lower volatility and less capital appreciation than growth stocks, making them suitable for risk-averse investors who seek a regular income stream. Investors can access income stocks through the Amplify High Income ETF, or YYY. Second, blue chip stocks. Blue chip stocks are well-established companies that have a large market capitalization. They have a long, successful track record of generating dependable earnings and leading within their industry or sector. Conservative investors may top-weight their portfolio with blue chip stocks, particularly in periods of uncertainty. Some examples of blue chip stocks include computing giant Microsoft Corporation, ticker MSFT, fast food leader McDonald's Corporation, ticker MCD, and energy bellwether ExxonMobil Corporation, ticker XOM. Third, defensive stocks. These generally provide consistent returns in most economic conditions and stock market environments. These companies typically sell essential products and services such as consumer staples, healthcare, and utilities. Telecommunications giants AT&T, ticker symbol T, and healthcare multinational Cardinal Health Inc., ticker symbol CAH, are among the defensive stocks included in the core holdings of the Invesco Defensive Equity ETF, ticker DEF. Stocks can also be categorized based on their tenure, social outlook, and price. First, IPO stocks. When a company goes public, it issues stock through an initial public offering, or IPO. IPO stocks typically get allocated at a discount before the company's stock lists on the stock exchange. It may also have a vesting schedule to prevent investors from selling all of their shares when the stock commences trading. Market commentators also use the term IPO stocks when referring to recently listed stocks. Second, environmental, social, and corporate governance, or ESG, stocks. These emphasize environmental protection, social justice, and ethical management practices. For instance, an ESG stock may be a company that agrees to reduce its carbon emissions at a greater rate than national and industry targets, or one that manufactures equipment for renewable energy infrastructure. Third, penny stocks. A penny stock is equity valued at less than $5 and is considered highly speculative. Although some penny stocks trade on major exchanges, many trade through the OTCQB, a middle-tier over-the-counter, or OTC, market for U.S. stocks operated by OTC Markets Group. Penny stocks shot to prominence in popular culture after the release of The Wolf of Wall Street. Here are some must-know terms about stocks. Stocks, shares, and equities. These words all mean the same thing. Ticker symbol. A short string of letters that identifies a given stock. If you wanted to trade Amazon stock, you would look up its ticker, AMZN, with your broker. Share price. The price the stock is currently trading for in the market. Dividend. What a company pays out periodically to shareholders. Not all companies pay dividends. Younger companies often prefer to hold onto their cash so that they can use it to keep growing their businesses. Earnings per share, or EPS. The company's total profits for a given period divided by the number of shares. It's an estimate of what portion of profits each shareholder is entitled to. In theory, investors don't actually get paid this amount. Some companies get cheeky with their ticker symbols, like Harley-Davidson, ticker HOG, or HOG, mattress company Sealy, ticker symbol ZZ, and Heineken, ticker symbol HEINY. A fat finger error is when a trader accidentally adds extra digits to a trade, like the time a Lehman Brothers trader entered a stock order for 300 million pounds instead of 3 million pounds and briefly wiped out about 30 billion pounds in value from the London Stock Exchange. You can think of the stock market as one giant auction, except the auction never ends. Each trading day, shares of Amazon and every other publicly traded company are potentially up for sale, and prospective buyers and sellers put out bids for what they're willing to pay or receive for the shares. The interplay between buyers and sellers is what drives the stock price. If one group of investors thinks Amazon stock is actually worth $4,000, then they will probably be willing to buy it at $3,000. If another group of investors thinks the stock is only worth $2,000, they will probably be willing to sell it at $3,000. How do investors come up with their opinions of what the stock is worth? People disagree about the best way to figure out a stock's value, but one of the most common ways is to estimate the company's future profits and then decide how much you're willing to pay for those profits. Anytime news comes out that could potentially affect the stock's price, whether news on the company itself, the economy in general, or any issue that touches on the company's business, then each of those investors may adjust their opinions of what the stock is worth. All those tiny adjustments are what fuel the stock's day-to-day movements in price. We shall learn about valuing companies and their shares in detail in later sessions. There are a number of methods and each one is quite involved. So, how do we read a stock chart? Let's take Apple as the example for us to master how to read the information presented to us in any financial website. You can see the one-year chart on Apple, and a lot of information presented in this summary chart. Let's go through each section at a time. On the top left, you will see the ticker symbol and the name of the company and the exchange where it is listed and the currency in which the stock trades. In this case, the company is Apple, Inc. It trades in the NASDAQ stock exchange and is quoted in US dollars. On the top right, you will see the closing price of the shares and the after-hours trading information in case a stock trades after hours. In this example, Apple closed on the last trading day at $131.56 per share, but is 1 cent down in the after-hours trading. The graph in the middle shows how the share price moved up and down over the last 1 year, since we selected the 1-year option for the data. If you had selected any other time period, the graph would change accordingly, from 1 day to 1 month to 10 years, etc. Here you can see the bars showing relative trading volume each day. The higher the bar, the more shares were traded that day. It gives you a sense of how many shares changed hands that day on a relative basis. A steady trading volume is good, but sudden spikes and otherwise low trading volume would indicate lack of sustained interest in the stock. On the leftmost pane highlighted, you can see where the stock opened trading. What was the intraday high and the intraday low reached by the stock? Compare it to the price above, which is the closing price of the stock. In this case, Apple opened the trading day at $130.06 and ended the trading day at $131.56 per share. During the trading day, it attained a high of $133.08 and a low of $129.81 per share. On this pane, you will see the total number of shares that changed hands on the last trading day. That is given by vol or volume. In this case, 134.5 million shares changed hands on the last trading day. The P/E ratio of 21.44 indicates that the closing price of $131.56 represents a 21.44 multiple of the EPS or earnings per share. P/E tells you what multiple the stock is trading at with respect to the per share earnings. Lastly, the market cap of $2.129 trillion represents the share price multiplied by the total number of shares of Apple outstanding. You can calculate the total number of Apple shares outstanding by dividing the market cap by the share price. Here you see the high and low of the last 52 weeks trading data. In this case, Apple reached a high of $182.94 and a low of $129.04, and the average daily volume of 96.06 million shares traded on the exchange. This gives you a sense of the market liquidity available. The lower this number means lower the liquidity. In the final section of the chart, we can see that Apple pays a dividend, where the yearly or annual dividend is equal to 0.7% of the share price as it stands today. Beta indicates a relative risk associated with the company versus the broader market. The higher the beta, the higher the risk. The lower the beta, the less the risk with that stock. If beta equals 1, the stock has the same risk as the overall market. Less than 1 means less risky than the overall market, but more than 1 means more risky than the overall market. Finally, the EPS is the earnings per share. If you divide the net income of the company by the number of shares outstanding, you will get the earnings per share, or EPS. Different portals display the same data in slightly different ways, but the essence remains the same. Let's watch a short video on stocks courtesy of Napkin Finance.
Stocks. Stocks are ownership stakes in companies. When an investor buys shares in a company, they become a shareholder. Each stock they own is a piece of ownership in the company. People invest to earn a return on their money. When you invest in stocks, you can earn a return in two ways. With price gains, if the stock you own rises in price and you can sell it for a higher price than what you paid, and with dividends, which are cash amounts that stocks may pay to shareholders periodically. One question you might be wondering is how stocks are valued, and what makes one stock worth $200 while another is worth only $20. Investors usually weigh a few considerations. A company's cash flow, like how much cash it receives from customers, any latest news, like if a company has launched a new product or been involved in a controversy, and its future profits, and whether investors expect those to rise, fall, or stay flat. One of the most successful stock investors of all time is Warren Buffett. He's said he follows two tried and true rules for stock investing. Rule number 1 is never lose money, and rule number 2 is never forget rule number 1.
In summary then, let's look at the main takeaways. First, stocks are small pieces of ownership in a company that you can buy and sell in the stock market. Investors can make money on stocks through dividends, price gains, or both. And second, there are thousands of stocks in the world, but investors make sense of them by sorting them into categories based on company size, geographic focus, industry, and more. Investing in stocks is risky, and one can lose one's money too. Thank you for your time. Until next time then, stay enriched and strong.